as we change our assumptions about what happens to prices, the LM curve in particular is strongly affected. So again, remember that when we introduced the LM curve, we had a situation with fixed prices. If you want to think of this as kind of an extreme short-run version of an economic model, over time prices clearly change, and that's going to also affect the demand of private citizens to hold cash in their pockets. So remember, money supply is the amount of currency and demand deposits that the private sector is willing to hold, or that's available. The demand is going to be how much they're willing to hold. So one of the critical aspects of this is relating what we talked about earlier as a determinant of money demand, which was the nominal interest rate. Now, the nominal interest rate, when prices can change, reflect two different economic concerns. First, there is a real interest rate, which is the, if you will, the price on alternative assets, alternative places to put your funds. So you're going to, if you invest in, say, in a new company, you're going to be paid the marginal product of capital in that company. You're going to have a return on that, and so that you're going to have at least that to compare to your holding cash. Plus, there's going to be an inflationary expectations built in. Now, in a separate video, we talked about real interest rates and how nominal interest rates will be equal to that alternative investment R, the payment on that alternative investment R, plus inflationary expectations. So we can write the money demand as really a function of not only the nominal interest rate, but decomposing the nominal interest rate into the real and inflationary expectations and then output. So if you recall, if nominal interest rates go up, the demand for money tends to go down. Now we have two sources of that change in the nominal interest rate. One is change in inflationary expectation, and the other is the payment for a return in other investments. So we have the money supply and the price level. So the left-hand side of here hasn't changed. So now we're going to look at the money market when we have changing prices, when we're looking at the real money demand and real money supply. So real money supply is the nominal money supply, how much cash and currency is in circulation, divided by the price level. That's the purchasing power, if you will, of the money in circulation. And then we've got real money demand, which is as we described. Now, otherwise, this looks very, very similar to what we had done before. Now, there are a couple of things that we have added here. Let's look first on the demand side. The real demand for money will tend to decrease, would tend to shift to the left if there are inflationary expectations. There'll be less willingness to hold cash if people think that there's going to be inflation in the future. If there is an increase in the return to other investments, you'll also have a shift of the demand curve to the left. Now, if you have falling output, or recession, if you will, that demand will shift to the left. And that's very similar to what we have done before. Now, the other aspect that's different than what we had analyzed before is that this real money supply in an earlier video changed only if you changed the money supply. Now we have the possibility of that real money supply changing if prices change. So if, for example, the price level goes up, there's an increase in the price index for the entire economy as a whole, that will reduce the real money supply, because if the price level goes up for a given stock of money in circulation, you're going to have your dollar bills can go less far. That is going to change the real interest rate. So one of the things about this new arrangement is that it's going to allow us to depict an LM curve with changing prices by taking this into account. So let's do that. We're going to do the same kind of analysis that we did before with the taking into account the quantity, the real quantity of money, and the difference being that we're going to have the real interest rate on the axes. Now this LM curve is going to have exactly the kind of shape that we've talked about before, for all the same reasons. If, for example, output goes up, the demand for for money will increase. The interest rate that will clear the money market will be higher. Okay, so we have exactly the same story here that we had before with the LM curve, just with the real interest rate on the axes instead. But now, again, let's think about how what would happen if we had a change in price. And this time, let's imagine an increase in the price level. Now, to see how this changes the LM curve, we need to go back to this graph and say, okay, well, if you've had an increase in the price level, what you're going to see is a decrease in the real money supply because of that price increase. The existing money stock doesn't go as far, as we talked about before. We had an original real interest rate, and it now has to rise in order for consumers to be satisfied with the lower level of money stock. Basically the return on other alternative assets has got to rise in order for the consumers to be happy with the fewer real value of dollars in circulation. So let's take a look at how that affects the LM curve. Now in this instance, there's nothing over here that has changed the level of output. All we've done is changed the price level. So what we have is that at the same level of output, a higher level of prices essentially real interest rate has to be higher. And that means an LM curve that shifts to the left when the only thing that has changed is the price level. Now, as we get into various analyses where, for example, you push the economy into a point where there are higher prices for various reasons, we're going to see that this LM curve shifts, and it's going to have an impact on the overall situation in the economy. So another thing that can change the LM curve would be changes in the expectations of inflation in the future. But let me set that aside for now and just focus here on the increase in the current price level will shift the LM curve to the left when we have real interest rates and output on the axes.